Hello and welcome to BYJU'S Exam Prep IAS. In today's discussion, let's cover certain very important articles related to economics which have appeared from 5th of February to 11th of February 2022. Let's begin the discussion. The first very important article which I am pretty sure all of you have gone through or at least have basically glanced through is the monetary policy review which was conducted very recently. Now, in the context of Indian economy, which is facing a very high rate of inflation, which needs a higher impetus for the growth rate, which is also concerned about the higher inflation rates across the global market, etc., this particular monetary policy review becomes very important. Now, what are the important announcements or the monetary policy statements which have been provided in this particular review? First and foremost, the Monetary Policy Committee has not changed anything with respect to interest rates. Repo rate, reverse repo rate have not been changed, they have kept unchanged. But this was a surprising move by RBI considering inflation rates in case of domestic market are higher. Various experts basically stated that they would have increased the reverse repo rate, that is, the RBI or the Monetary Policy Committee should have increased reverse repo rate, which would basically bring the liquidity in the market down and it will help in controlling inflation. Now, some of you would be worried, sir, why repo, that is reverse repo rate, should be used in this particular context. The banks have higher amount of money now. If RBI increases reverse repo, banks would be taking this particular surplus amount of money that they have and will be depositing this money with RBI. When the banks do that, they will have lesser money to issue in the market, the credit disbursal will come down, the investments in the market, right, will come down, that is, let's say in the form of a demand, and it will help in controlling inflation. So, various experts even before the policy was announced had expected that RBI would be or the Monetary Policy Committee would be increasing the reverse repo rate, but that was not the case. Second, the Monetary Policy Committee has stated that it will continue with the accommodative policy or accommodative stance as long as it is necessary to revive and sustain the growth rate in the economy. Third very important point, ensure that inflation remains within the target. And in this particular context, one very important concern that has been flagged by the committee is that the rates of fuels in the international market are rising upwards. Okay? The market prices or the international crude oil prices have been inching towards around $90 per barrel, and this is a cause of concern that they are saying. And basically the policy statement says that we should keep a very close watch on what will happen to these particular crude oil prices in the market. That is the third very important point. Fourth, the CPI, Consumer Price Index, has been higher compared to the level it was during the previous meeting, and even the core inflation has remained elevated, and that is also a cause of concern, because generally when we say core inflation, we consider those particular commodities whose prices are not volatile, whose prices do not go up and below in a short period of a time, right. So, generally we consider those particular commodities whose prices are more stable in a longer duration. But what we can see here is even the core inflation has remained elevated, which will basically create a headache for the Monetary Policy Committee in the coming days. Two next very important changes announced are, one related to e-rupee. Now, what is this particular e-rupee? E-rupee is essentially a digital voucher. Okay? E-rupee is essentially a digital voucher which is faceless, cashless, contactless, person specific and purpose specific voucher issued by the government. Now, earlier related to this particular e-rupee digital voucher, the threshold limit of this particular voucher was kept at 10,000 rupees. Is it okay? The voucher value at the maximum was fixed at 10,000 rupees. Now, this has increased to 1 lakh rupees. The limit has been increased to 1 lakh rupees. And this is expected to provide an impetus for more and more usage of the e-rupee digital vouchers. And not just this, RBI has also stated that they are going to increase the number of times that this particular voucher can be used now. That is, imagine I receive a voucher from the government. Now I can use this particular voucher multiple times as against the earlier practice of using it only once. And so far, remember this, so far these particular digital vouchers are being issued only in the context of providing vaccination. Now RBI simply says that one, the amount of value or the threshold value under this particular voucher, we will increase it to 1 lakh rupees, and we will allow the beneficiaries to use these particular vouchers multiple times until and unless the value is exhausted, value is reduced to 0, this particular voucher can be used multiple times now. This is expected to provide more impetus to usage as well as the issuance of digital e-rupee or the voucher as such. Next, FPI investment limit under VRR, that is VRR essentially stands for voluntary retention route. Is it okay? VRR essentially stands for voluntary retention route. So under this particular route, the limit has been increased from 1.5 lakh crore rupees to 2.5 lakh crore rupees. So what is the importance of this? Importance, first and foremost, understand this. Under the voluntary retention route, RBI, which has introduced this particular route, wants to attract stable investments from the foreign market into India. I will repeat the statement. We want to attract more investments, that is the foreign investments in the market. Yes, both in the equity market as well as the debt market, we want to attract more and more investment. Focus on the debt market here. Within the debt market, generally whenever the foreign investors, that is the FPIs, foreign portfolio investors, when they want to invest, there are certain restrictions, there are certain conditions on their investments. Now RBI, in order to attract a lot of stable investments from FPIs, has introduced the concept of voluntary retention route. Under the voluntary retention route, right, so far the limit of FPI investment was fixed at 1.5 lakh crore rupees. And remember one more point here, under VRR, the RBI will allow the investments in the debt market, that is the government debt market, as well as corporate bond market also. Government debt market, essentially government bonds, and it will also allow, right, these particular investments, that is FPI investments, even in the corporate bond market. Separate limits will be decided for the government bond market as well as the corporate bond market under VRR. Now there is a concern that with Fed tapering or with rise in the interest rates by Federal Reserve, there could be a sudden outflow of foreign investments or FPI investments from India to, let's say, USA. And in order to control this damage that would be caused by this particular Fed tapering practice, RBI has increased the threshold limit or the investment limit under voluntary retention route from 1.5 lakh crores to 2.5 lakh crore rupees. And the final important announcement, RBI has introduced the concept of trade receivables discounting system. Okay, trade receivables discounting system, which can be used by the MSMEs to increase the amount of liquidity or wherein they can sell the receivables to a financier in the market to receive money. And under this particular trade receivables discounting system, until now the threshold of transaction was fixed at 1 crore rupees. Okay, for the settlement, the highest value of transaction threshold was fixed at 1 crore rupees. Now this has been increased to 3 crore rupees. Again, the importance is very simple here. With increased threshold limit like this, now MSMEs can use the trades platform more and more for a higher value of receivables discounting also. Right, so these are some of the very important announcements that has been done very recently by the Monetary Policy Review Committee. Let's go to the next article. Centered to form FPOs with smaller farmers. First and foremost, what do you mean by FPO? FPO is a group of producers. Is it okay? FPO is essentially group of producers. What kind of groups are we forming, or what kind of producers group are we forming here? Basically, we are forming a group of the farmers or the cultivators. Is it okay? We are trying to form the group of farmers or cultivators. Now, what is the advantage? Why are we focused on this? every now and then government introduces certain very important measures which will help in protecting the interest of the cultivators or farmers. For example, in the context of farmer producer organization, Government of India now has targeted that it wants to create 10,000 FPOs. Is it okay? It wants to create 10,000 of these particular FPOs in the next couple of years. And what is the objective? Why is Government of India so much focused on the creation of these particular FPOs? Rather than the farmers individually dealing with the market, now it makes more sense for the farmers to make groups, right, called as a farmer producer organization registered under Section 25 Companies Act, and these particular FPOs will procure from the farmers, sell them in the market. And how it is going to be beneficial for the farmers? Imagine I am an individual farmer, me taking the crop, trying to negotiate prices in the market is much more difficult compared to me being a part of a group where the FPO purchases the crop and negotiates with the other traders in the market. It makes more sense in the second situation to protect the interest of the farmers. So that is the reason Government of India has been promoting more and more creation of this particular farmer producer organization. And very recently the Prime Minister in one of the speeches has stated that we will try to promote, or we will basically promote creation of more and more FPOs even with the smaller number of farmers. Right? This was the gist of the article provided here. Next, ATF under GST. ATF essentially stands for Aviation Turbine Fuel. Now, first and foremost, what are the important points here? Although the article is very short with respect to FM announcing that the issue of covering ATF under GST will be taken up in the next GST Council. That is what has been provided in the article. But let's go beyond what is given in the article. Let's try and understand what are the important aspects related to the UPSC from this particular issue. First and foremost, remember this, the fuel products, is it okay? The fuel products right now are not covered with the GST rate. That is, there is no GST rate applicable on the fuel products. For example, petrol, diesel, aviation turbine fuel. When the GST as a concept was introduced under 101 or 101 constitutional amendment, essentially the GST is defined as a tax on goods as well as services. A tax on goods as well as services. But it excluded, I repeat, it basically excluded the alcohol that is used for human consumption. Okay, alcohol that is used for human consumption. But in addition to this, the GST Council basically decided that let's not announce the GST rate on these particular fuel products. In the future, we will decide when we will basically bring it under GST and have GST rate on these particular fuel products. That is the first very important point. Second, in that case, how the fuels are taxed currently? How is the fuel taxation applicable in India? For example, in the context of aviation turbine fuel, ATF attracts the central excise as well as the state VAT. The ATF basically is attracting 11% tax from the central government, that is the central excise, and VAT from one state to another state, it will vary, you do not have to remember. But what is the problem here? The problem is that when the airlines or the service providers pay so much of tax on the ATF, it forms around 60% of the cost of a ticket itself. Is it okay? It forms around 60% of cost of ticket, that is overall ATF charges which are paid by the airliners, including taxes, the market price of this, etc. It forms around 60% or generally around more than half of the ticket price itself. And the problem within this itself is that because the VAT attracts a central excise as well as the VAT, these two are not provided as an input to tax credit under GST, because if the GST is not applicable, there is no GST rate on this, right? Naturally, there is no input tax credit provided for these particular products. So, ITC is not provided on this particular fuel, and as a result of this, the airlines will basically transfer this particular tax to the customer who is actually using their services, and that is one of the reasons why these particular the ticket prices are very high. That is second point. Third very important point, in recent times, as already mentioned, crude oil prices are inching upwards, they are increasing, and we get ATF as one of the components out of the crude oil itself. And if the crude oil prices remain very high or increase because of various international issues that are taking place, it will become very difficult for these particular airlines to provide the same services without increasing the ticket prices. And as such, already civil aviation market is one of the battered sectors within the Indian economy thanks to pandemic, and that would create so many problems for the whole economy, specifically civil aviation sector as such. So, in order to address all of these particular issues, the finance minister very recently has announced that in the upcoming GST council meeting, she would propose inclusion of the fuel products starting with aviation turbine fuel. Now, some of you might be thinking, sir, there are so many fuel products, petrol is there, diesel is there, etc. But why are they targeting ATF specifically? The ATF, please remember this, when compared to petrol or diesel, the consumption of ATF is much lower. Is it okay? The consumption of ATF is much lower. For example, in the current year itself, that is for 2022, the ATF consumption is somewhere around 4 million tons, whereas the petrol and diesel are more than 25 million tons. So, obviously, states will not be much concerned, much worried about loss of the revenues if the ATF is brought under GST, and this could be a very good starting point to include all the fuels under GST in the coming days. And mind you, the central theme of GST is one nation, one tax. Is it okay? The central theme of GST is one nation, one tax. So far, we have not been able to achieve the concept of one nation, one tax. So, this inclusion of ATF is basically a movement towards achieving one nation, one tax concept. So, these are some of the very, very important points with respect to ATF to be included under GST. Now, based on this, I have given a question here. Consider the following statements. The ATF attracts both central excise and VAT by the state. Yes, statement is true. The airlines get ITC on the taxes paid on the ATF. No, this particular statement is wrong, right? So, remember this. But a very interesting fact related to the airlines industry is that although the fuels on which they are paying the taxes both to central and state, there is no ITC provided, but the airline tickets, is it okay? The airline tickets, on this the GST is applicable. On the airline tickets which are sold or which are purchased by all of us, there is a GST imposed on this. For economy class, 5% GST is applicable, and for all the other classes, the GST applicable is 12%. Okay. So, first statement is true, right option in this particular case will be option A, only one is correct. Let me go to the next article here, NBFCs and credit cards. Now, what is the discussion provided here? First point, currently NBFCs are not allowed to issue credit cards. Individually, they are not allowed to issue credit cards. Sir, what do you mean by individually they are not allowed to issue credit card? Imagine there is an NBFC A. This NBFC A alone will not be allowed to issue credit card. No way, RBI doesn't allow it. Whereas, the same NBFC can join hands with, let's say, another bank, and these two entities together are allowed to issue credit cards. Is it okay? Both of them together are allowed to issue credit cards like this. That concept is actually allowed, and RBI allows this one. Second very important point, there was one report last year by MasterCard and Niti Aayog. Okay? There was one report by MasterCard and Niti Aayog, and under this particular report, what they have stated is, there are a lot of barriers which are put on NBFCs to enter into a credit card market and individually issue credit cards like this. Rather than imposing the barriers like this, we should allow even NBFCs to individually issue the credit cards. And what is the argument put forward in this particular report? They say that in the last couple of years, the digital lending activity has actually picked up in India. Is it okay? The digital lending activities has actually picked up. There are many fintech companies which are raising huge amount of loans, which have collected huge amount of investments from the market, and they are using these particular investments to target large number of salaried people, salaried earners in the formal sector. For example, have a look at this particular data here. There are 120 million formally employed Indians who do not have a credit card. Right? There are 120 million people like this. So these are the people, or these are the customers to whom these particular fintech companies or the startups have been targeting and giving huge amount of digital loans to these particular borrowers. So looking at all of these particular points, what this particular report basically recommended was, why don't we reduce these entry barriers for the NBFCs rather than having a co-lending activity like this, wherein both, that is NBFC and a bank, is coming together to issue a card like this as a credit card. Why don't we allow only NBFCs to issue credit cards in the market? And that will basically help NBFCs to diversify, expand their customer base. It will also help us to achieve financial inclusion, etc. And that is what is discussed in this particular article also. The article basically says that recently there has been discussion between RBI as well as NBFCs, wherein the NBFCs are asking RBI to allow them individually to issue credit cards. And in the coming days, this particular issue might be resolved and NBFCs can be allowed to issue credit cards individually rather than having a tie-up with the banking sector like this. Done? Right. So these are some of the very important points with respect to article provided here. Now, based on this, I have given a question. Consider the following statements regarding Sachet portal. Now, this is not there in the current affairs. Mind you, this is not there in this particular article discussion. But when I was reading that report which has been published by MasterCard as well as Niti Aayog, they had mentioned this particular Sachet portal in that particular report. So I felt okay, because the report was published last year, still it becomes very important for UPSC. So this particular Sachet portal is maintained by Reserve Bank of India. Remember this. It is maintained by Reserve Bank of India. So first statement has been set up by the Ministry of Consumer Affairs. Statement is wrong. What is the objective of this particular portal? The customers, will basically be allowed to file complaint or allowed to file information on illegal or fraudulent deposit schemes which are introduced by people or let's say by institutions in the market. So against these particular fraudulent schemes, you can file information using the tabs which are provided in this particular portal itself. So second statement is true, first statement is wrong. Right option will be option B, only 2 is correct. Let me go to the next article. RDSS scheme or simply RDSS. RDSS, first point, stands for Revamped Distribution Sector Scheme. Okay, Revamped Distribution Sector Scheme. This particular scheme was introduced by the government in the second half of 2021, somewhere in the month of July 2021. Now, what is the objective of this particular scheme? Very simple. Before RDSS, there was one more scheme by the name of UDAY, Ujjwal Discom Assurance Yojana. And under UDAY, Government of India, which was introduced by Government of India, wanted to address the financial distress in the distribution companies. And under UDAY, the objective was to reduce the gap between average revenue realized and average cost of supply, and to basically reduce the aggregate technical and commercial losses. Is it okay? One, reduce the gap between average revenue realized and average cost of supply, which essentially means the Discoms are selling electricity. For that, they are incurring more cost, and when they are selling or supplying electricity, they are collecting money, charges, which is lower. So, average cost of supply is higher than the average revenue realized. They wanted to bridge this particular gap. When this particular scheme was actually introduced back in 2016, the gap between ARR and ACS was 0.48 rupees or 48 paisa. And by the time in 2020 the scheme got ended, or the scheme duration was over, it was reduced to 0.3 rupees, that is 30 paisa, which essentially means we were unable to meet the targets which are given under this particular Uday scheme. And same thing was seen even in case of AT&C losses. Before the introduction, it was somewhere around 24%, it was reduced to around 20%, whereas the target was much below this. Right, so we were unable to meet the targets under Uday scheme. Now, to address the lacunae in the system, right, with respect to Uday scheme, government introduced one more scheme in the name of revamped distribution sector scheme. Under the RDSS, the targets are almost the same, but please understand this. First very important target is we want to bridge the gap between ARR and ACS, and second, we want to reduce the AT&C losses between 12 to 15%. Now, some of you look at both of the sides and say, sir, here also it was same, here also it is same. Then why are we referring to this as a revamped distribution sector scheme? Very simple. This particular scheme has been announced for the duration of 5 years. First point, okay? It has been announced for a duration of 5 years, starting from 21-22 till 25-26. But more importantly, under this particular scheme, Government of India has set aside or allocated 3 lakh crore rupees. Okay, 3 lakh crore rupees. But understand the very important difference between the first scheme as well as the current scheme. In the current scheme, Government of India simply says that if you want to get the assistance under the scheme, you will have to meet certain conditions. And that is where the difference lies between Uday and RDSS. Under RDSS, the Discoms, right, whatever reports, whatever targets they have set up annually like this, these particular targets have to be met. And who will keep the targets for these particular stakeholders? The state governments will prepare project plans, and annually what is the target that they want to achieve, those particular targets will be provided to the government, and what has been the performance of the states with respect to these particular targets, that information will also be reported to the government annually. And only looking at the performance report of the states, the central government will release the funds under this particular scheme. That is the first very important change that has been done by the government under RDSS. Second very important change, one of the biggest issues with respect to Uday scheme has been that the state Discoms are supplying electricity to other agencies of the state government. The agencies are consuming electricity, but when it comes to question of making a payment to the Discom, there is a delay. There is a default by these particular agencies. Now, under RDSS, the second condition is the same thing. The other state agencies, other bodies under the state government, whoever purchases electricity from a Discom, they will have to make timely payment. Right, that is the second very important condition under RDSS, and this is how Government of India is trying to address the issue in the Discom sector with the implementation of the revamped distribution sector scheme. So, these are some of the very important points related to articles provided here. Now, based on this, I have given an MCQ here. Consider the following statements regarding RDSS. It will be implemented for a period of 5 years. Yes. It aims to reduce AT and C losses to 0. No. Right, the gap between ACS and ARR, we want to reduce it to 0. But what about AT and C losses? 12 to 15%. That is the target under RDSS scheme. So, second statement is wrong. First statement is true. Right option will be option A. Only one is correct. Next article, EPCG scheme. In the recent times, there has been a discussion with respect to should we continue this particular scheme or we simply should revamp or let us say withdraw this particular EPCG scheme. What are the important points? Why this particular scheme is so important? First and foremost, EPCG stands for Export Promotion Capital Goods Scheme. Okay? EPCG stands for Export Promotion Capital Goods Scheme. Now, what do you mean by Export Promotion Capital Goods Scheme? Imagine you want to manufacture a product. Okay? Imagine you want to manufacture a product, but for the manufacturing of this particular product, you want a capital good to be imported from rest of the world. Is it okay? You need a machine. Capital goods essentially means machines. So, you want to manufacture a product. To manufacture this particular product, you require a capital good. Now, government under this particular EPCG allows you to import this particular capital good either for production, pre-production or post-production activity. And because government wants to promote manufacturing, whatever surcharges or for example cesses or import duty is applicable on the import of this particular commodity, or that is a capital good, that will be exempted. Is it okay? I will repeat the process here. Under EPCG, imagine you want to import a capital good for manufacturing. Then the government will allow you to import that particular capital good, and whatever import duty is applicable or cesses that is applicable on this particular imported product will be exempted, or you can simply say it will be 0% on these particular capital goods which you are going to import. But government will not simply give you this particular exemption. There is a condition attached to it. What is the condition? Let's take a very simple number here. Imagine you imported a capital good, and in the form of import duties, cesses, etc., you were supposed to pay, let's say, 1000 rupees to the government. Is it okay? In the form of import duties, taxes, right, cesses, etc., you are supposed to pay 1000 rupees to the government. Government says you don't have to pay this. I will reduce it to 0, right? So you don't have to pay this. But there is one condition. What is the condition? Whatever is the exempted tax plus cesses plus import duties that you are going to enjoy, in the next 6 years, you will have to export 6 times this exempted duty. Is it okay? In the next 6 years, you will have to export 6 times this particular exempted duty. Again, under that also there is a concept of export obligation. You don't have to be worried. So, understand this particular scheme is referred to as EPCG scheme, and in the last couple of years, this particular EPCG scheme has been used by multiple manufacturers in the domestic market. The data is given here, right? More than 90,000, right, of these particular approvals have been issued, right, in the last 6 years by the government itself. But what has been the concern related to this scheme? One concern is this particular scheme violating WTO norms? Is it okay? It is conforming to the WTO regulations or norms, or is it violating? Some of the experts seems to think that it is violating the WTO norms. So, government is considering whether should I simply withdraw this particular scheme. That is the first point. Second very important point is this particular scheme will give you exemption or will reduce the taxes on the imports to 0%. If I am going to import the capital goods and that is promoted under this scheme, don't you think that will hamper the domestic manufacturing of capital goods? Rather than promoting the domestic manufacturing of these particular goods, under this scheme you are promoting import of these particular capital goods, right? So, that is also one more criticism with respect to this particular scheme. So, government is considering should we withdraw, should we continue it, right? What is the viewpoint of the market? The market simply says that we must continue with this particular scheme. We should continue with this particular scheme if you want to promote more and more production in the domestic market, right? So, this is related to EPCG scheme. I have given a question here. Consider the following statements regarding EPCG scheme. The scheme covers import of capital goods and intermediary goods. It does not cover intermediary goods. The first statement is wrong. The importers will have to pay only 50% of the normal duties applicable. Statement is wrong. It will be reduced to 0%. So, right option for this particular question will be neither, right? That is, both the statements are wrong. Neither one nor two is correct. Next article, cell and module manufacturing, again related to the manufacturing of the solar modules, it has come into prominence thanks to the initiative of Government of India, that is the production linked incentive, under which the government is promoting module manufacturing in the domestic market. Very recently, Government of India in the budget has announced that PLI will be extended, or more allocation will be done under PLI to promote, right, the solar equipment manufacturing in the domestic market. Now, what are the important points related to this? Government of India wants to harness the solar energy, and basically that is the sunlight, and produce a lot of solar electricity in India. And as per the target given by the government, by 2022, we want to have 100 gigawatts of solar energy capacity in India, and every week once or twice this is there in the newspaper, remember this. Now, in order to promote the harnessing of the sunlight, right, we have started promoting solar energy production, but lot of these particular solar modules that we need or that we are using are imported from rest of the world, and it is not a surprise if I say that most of these particular imports are actually coming from China. Because generally when you manufacture the solar modules, the sequence of the supply chain or the sequence of manufacturing will be, first you will manufacture polysilicons, then you will manufacture ingots, then there are wafers which are manufactured, which are used to manufacture cells, and later finally we manufacture the solar modules. And again, it should not be surprising when I say that China is a leading country with respect to the solar cell manufacturing, solar module manufacturing, the wafer manufacturing, etc. In order to reduce the import dependence, Government of India very recently has allocated more money under PLI, or additional allocation has been provided under production linked incentive. And the objective of the government is, we want to add 25 gigawatts of cell manufacturing capacity, 25 gigawatts of module manufacturing, and 10 gigawatts of wafer manufacturing in the domestic market. And with that particular objective, right, the government has introduced or has increased the allocation, right, under the PLI to promote a cell as well as a module manufacturing in the domestic market itself. Done? Right. So, these are some of the very important points with respect to this article. Next article related to credit rating. After the budget announcement, some of the credit rating agencies basically stated that, right, India's debt to GDP ratio is very high, and also stated that there is no clear path which has been provided by the government in order to reduce fiscal deficit in the next couple of years. Right. So, there is an issue with respect to these indicators in terms of budget announcements, and came back the reply of the government. India's debt to GDP ratio is much better than many of the other countries in the international market. Now, whenever you talk about, right, the idea of a credit rating, I am talking in the context of sovereign credit rating. Is it okay? Remember this. Credit rating can be provided for individual instruments which are issued by the companies, and it can also be provided, right, for an economy which is referred to as sovereign credit rating. Now, what is the issue with respect to this particular debt to GDP ratio? Yes, it is true that India's debt to GDP ratio is high, right? It is not a surprise, it is true. But there is a reason why the debt to GDP ratio of India has actually increased. The borrowings of the central government as well as the state governments, because of the pandemic, have skyrocketed, have increased, and as a result of the borrowings are done by both of them, the debt to GDP ratio of India also is very high. Have you understand this? It is very high. And as per economic survey, the general, that is the overall debt to GDP ratio of both central as well as state was somewhere around 90%. The Government of India argues that the debt to GDP ratio of only India is not very high, right? What about USA? The debt to GDP ratio of USA is also very high. What about that of Canada? What about that of UK, right? So, there are so many other countries which also have a higher debt to GDP ratio. Why are you targeting simply the debt to GDP ratio of India? And within the emerging market economies or emerging developing countries, India's debt to GDP ratio is one of the most stable, right, parameters, or compared to other countries within this particular grouping, India's debt to GDP ratio is much better. Now, what is the concern generally raised by these credit rating agencies whenever the debt to GDP ratio increases? Should we be concerned? Should Government of India be concerned with respect to debt to GDP ratio? Definitely yes. Whenever the debt to GDP ratio increases, it is always a concern for the economy. Why? The debt to GDP basically represents the ratio of, right, how much money you need to repay compared to how much money you are generating in the domestic market. And if this ratio keeps on increasing, it becomes very difficult for the economy to pay back these particular borrowings. Right? And please understand this, whenever this increases, it also means that a large chunk of money that the government has is being used to repay the borrowings done by itself. I can understand, the large chunk of it is being used to repay the borrowings. For example, look at what has happened to interest payments by the central government. The interest payments as a percentage of revenue receipts have kept on increasing, and in the last couple of years, they have actually skyrocketed. They have actually increased by a very large number, and that should be a cause of concern. Having said so, this is not just applicable to Indian economy. In the last couple of years, every economy has been affected by the pandemic, and that is exactly what has been experienced by these particular countries. So the argument of Government of India is twofold here. One, our debt to GDP ratio is very stable, right? You don't have to be worried. It is very stable, especially within emerging market economies. It is one of the best performers in terms of debt to GDP ratio. Second, right, whenever these credit rating agencies provide these kinds of, let's say, analysis, they always have a stepmotherly treatment. That is, they treat the developed countries much better, even though they might be having a worse debt to GDP ratio compared to India. But when they treat India, right, the treatment is, right, a second motherly or stepmotherly treatment. Done? So these are some of the arguments which have been provided by the government in the context of debt, the rating agencies analysis of the budget. Right? So these are some of the very important articles that I wanted to discuss for the duration of 5th February to 11th February 2022. Now, if you like this particular initiative, please hit the like button and make sure that you provide your valuable comments in the section below. And if you have not yet subscribed to BYJU'S Exam Prep IAS, kindly subscribe. Thank you. Have a great day.